In this video, we will be delving into the latest global developments across the fields of world affairs, international relations, and technology. Our primary focus is on the current developments concerning the fiscal deficit of the United States, its association with China, and the efforts to stabilize the worldwide financial system. Specifically, we will scrutinize if the White House is seeking China's help to deal with the United States fiscal crisis due to high inflation rates, banking crises, interest rate hikes to control inflation, de-dollarization, and other trends. Based on a Reuters report on April 11th, John Kirby, the spokesperson for the White House National Security Council, declared during a press briefing that the U.S. is in touch with China to arrange a visit by Treasury Secretary Yellen and Commerce Secretary Raimondo to China. Kirby emphasized the United States' commitment to establishing a stronger foundation for the relationship between the two countries. On the same day, the Wall Street Journal quoted unnamed sources claiming that a senior official from the United States Treasury Department recently visited Beijing, indicating that diplomatic communication is still ongoing despite recent tensions. The U.S. financial system is under significant pressure due to the Federal Reserve's aggressive interest rate hikes, the highest level of inflation in more than 4 decades, a banking crisis due to attempts to curb inflation, an increase in the debt ceiling to avoid a government shutdown, and de-dollarization trends worldwide. Despite these challenges, Jay Shambaugh, the Undersecretary of the Treasury for International Affairs, asserts that the U.S. has no intention of decoupling from China or limiting its growth. While the U.S. may have concerns about China's economic policies and will safeguard its economic interests, it has no plans to fully separate the two economies since it would be impractical and not in the best interest of the U.S. The White House also disclosed on April 10th that it was discussing with China arrangements for visits by U.S. Treasury Secretary Yellen and Commerce Secretary Raimondo to China. John Kirby acknowledged that U.S.-China relations were tense but stated that the U.S. was eager to restore a stable and positive relationship. Senior Commerce Department officials, including Elizabeth Economy, a senior advisor to the Commerce Secretary on China, were scheduled to visit Beijing and Shanghai that week to lay the groundwork for a possible trip by Commerce Secretary Raimondo later in the year. Experts speculate that Yellen's visit to China aims to request that China stop reducing its holdings of U.S. debt. According to Yellen, the U.S. federal government's fiscal deficit increased to $262.4 billion in February, a 62% rise from the same period last year. If this trend persists, the federal government's total debt will reach $51 trillion in 10 years. In an April 10th report, the World Gold Council discussed the future trend of gold purchases by global central banks. The report highlights that global central banks have had to buy large amounts of U.S. treasuries with low or even negative real yields on many types of bonds for more than a decade. The current U.S. financial crisis and previous Eurozone debt crisis indicate that the U.S. faces significant default risks that cast a shadow over the safety of U.S. debt. The current market dynamics are leading to a shift in global investments, with gold becoming an increasingly attractive asset compared to U.S. treasuries. This shift is causing countries like China to accelerate their liquidation of U.S. debt in favor of gold purchases, as evidenced by China's continuous increase in gold reserves over the past few months. This trend is not limited to China, as global central banks, including Malaysia, are also increasing their gold holdings to the highest levels in 55 years due to the stability offered by gold in comparison to the dollar. The latest data from the World Gold Council shows that global central banks have been buying a net of 125 tons of gold in the first 2 months of this year, which is the strongest performance since 2010. This trend of gold purchases has been going on for 11 consecutive months, with central banks buying a record high of 1,136 tons of gold in the previous year alone. Over the past 12 years, central banks have purchased a total of 6,940 tons of gold, with the pace of purchases accelerating in recent years. This trend towards de-dollarization of external reserves is evident in central banks' increased gold purchases and slower growth in U.S. debt holdings since the introduction of several rounds of quantitative easing in the U.S. in 2008. China, for example, has been increasing its gold reserves for 5 consecutive months while also accelerating its liquidation of U.S. debt. On the other hand, its U.S. debt holdings have been falling below $900 billion for 4 consecutive months. This suggests a deliberate effort to reduce China's exposure to the dollar and push for a greater role for yuan assets globally. Other countries, including France, Germany, Belgium, Saudi Arabia, Brazil, and Israel, are also reducing their exposure to U.S. debt, reflecting a trend towards global central bank de-dollarization. European countries, in particular, are taking over the flag of de-dollarization from Japan and starting to reduce their investments in U.S. debt. France, for instance, has sold a net of $62.1 billion of U.S. debt in the last 10 months, which is the largest selling effort among European countries. This shift away from U.S. debt towards gold and other assets indicates a strategic move by these countries to reduce their investments in the dollar and actively look for other investment options. As emerging market economist Jason Tuvey noted, Saudi Arabia's move away from U.S. debt was a strategic one that highlighted the threat posed by increasing concerns over its debt. Even U.S. Treasury Secretary Yellen expressed her concerns in a letter to Congress, warning of the disastrous consequences that could result from a failure to raise the ceiling on U.S. debt in a timely manner.
Thanks for watching. If you found this video helpful, please consider subscribing for more content. Take care.